Let's get started. This webinar is dedicated to stop placement, which is extremely important part of risk management. In trading, we can't manage our returns, but we can still manage our risk. And stop loss is a very important part of risk management and risk control, which helps trader to survive and realize an edge that is built in trading system or method. Many traders have questions about stop placement. They want to know how to do it correctly. And I would say that in most cases it is more art than a science, and you will have to keep balance between two alternatives. The first is cutting losses short, and the second is having odds on your side. These two principles often contradict each other, and in this webinar I will go through different principles of stop placement and try to explain the rationale beyond each of them. Every idea will be supported with corresponding screenshots of trades. Every idea discussed in this webinar were somehow used for trading either for me or students of my educational groups. Now we are ready to start. And first of all, let's take a quick look at the disclaimer. Please be aware of financial risk associated with trading. Information in this webinar is provided for educational purposes only and by no means can serve as a trading or investment advice. You will have full responsibility for your trading decisions, so we strongly encourage you to test any ideas or concepts on a simulator or using historical backtest before putting real money at risk. And I want to start with a simple idea. When you start your own business in whatever sphere, you are going to have expenses. You may not have employees, but you still will have marketing expenses, production expenses, or advertisement expenses, and etc. But when we are involved in trading, we think in a paradigm of losses but not expenses. We may think that every loss could have been turned into a gain, and the difference between successful trader and average trader is knowledge. Well, knowledge is very important, but it is also important to understand that nobody really knows the outcome. Professional traders know that they are going to earn profit in a series of trades, and they can be careless about the financial result of a given trade. And that is called hindsight bias. We tend to think that we could have avoided loss in a trade if we only knew how market works, how market operates. In reality, nobody really knows the future, and I recommend you to treat your losses as expenses. Every experienced trader knows that there are not only periods when you earn profit from the market, but also there are periods when you give this profit back to the market. Of course, we want to have more profits than losses and cover our losses with profits, but these losing periods are inevitable. Sometimes they will happen, and we have to know how to manage them. And finally, in traditional businesses, expenses are considered as a norm. In trading, we tend to have feeling that we could have avoided losses or even turned it into profit. And I want to say that sometimes we can do that, sometimes we can't do that. This webinar is dedicated to managing losses as expenses. Okay, let's move forward. And there are two extreme points of view in a trading community. First is that stop loss is the only tool for managing risk. Once you have a stop, you are protected. Of course, having stop loss is an important part of risk management, but it is not the only tool. You also have to be aware of trade location, basic market conditions, and timing of your trade. In other words, you have to do many things to stack the odds in your favor. And later in this webinar we will talk about common ideas such as setting a stop to break even or using trailing stop as well. And the second extreme idea is that stops negatively affect trading performance, so it is reasonable not to have stops at all. They say that if you fix loss, you have this loss. If you don't fix loss, you don't have this loss. And this idea can bring short-term results, even having large drawdowns, but in the long run it is very dangerous idea because eventually you can lose entire account. So we will not even talk about this idea. We'll talk about this idea in webinars concerning risk management. So let's talk about ideas in the left column. First of all, we will talk about different methods of stop placement. Secondly, we will talk about placing your stops to break even. And eventually we will talk about trailing stops and talk about protection of your position with a trailing stop. So there are several ways to set a stop, and you can set, first of all, stop based on volatility. Secondly, you can place a stop based on a pattern. It can be whatever pattern, but if you trade with a pattern, you have to set a stop using this pattern. Also, you can set your stop using certain scenario. You can have a structural based stop, and you can have a dollar based stop or money based stop. In this webinar, we will not focus much on the fifth point on dollar based stop or money based stop. We assume that you know your risk before you enter a trade and you are consistent with your risk. For example, you take 1% per trade or 2% on a trade. I will dedicate separate webinar for this topic, so I will not focus much on it. But we assume that you have certain money management rule before you enter a trade, before you consider putting your money at risk. Let's start with stop based on volatility. There are several ways to identify volatility, for example, implied volatility or historical volatility. And here we will use historical volatility, which is measured by average true range indicator. In a nutshell, this technique is useful for the purpose of filtering the intraday noise. Example on this slide shows that if you wanted to enter a pullback trade on euro versus American dollar, which is shown here on this slide, you could have set your stop loss based on volatility. ATR, which is shown below the chart, is going from low values to high values, and it is not showing any direction. This indicator is going to show us the average size of the bar so that we can estimate what average size of the bar should we expect later in the price action. It is an average, so it doesn't mean that we can accurately measure this value. Now let's look how to set up this indicator in MT4 trading platform. I have here a chart of American dollar versus Canadian dollar. So if I want to measure average true range or average volatility of a price action, I have to go to the menu Insert, choose Indicators and Average True Range. After that, I have to choose the parameter, the period to calculate. Normally I use 21 as my working parameter, and you have the curve of the indicator located right below the chart. For position trading, we can use ATR on a daily chart, but for short-term swing trading or day trading, we can switch to lower time frames like M30, that is shown here on this slide, and use it for this chart. You have to know pretty clearly what situations are good for using ATR indicator. ATR measures volatility, so you have to deal with sort of a random price action. You don't have any setup, because in case you are using any setup, I mean candlestick formation or so, you have to set your stop loss below this setup or a pattern or above this setup or a pattern. In case you are employing volatility, you are expecting to go counter trend or go against the noise or so-called noise to establish a trade. For example, I was showing you this trade in previous webinars. I am going to show you it once again. I was entering the position right here. It is Canadian dollar, 1.3250 or so, 56 I believe, and I had to choose the distance for my stop loss. If you look at this situation, you see that there is no really a pattern here. We don't have a pattern or setup, no engulfing pattern, no pin bar or so it is just trade location that is good for going long, because the market was strong before, it was showing us the signs of support. So I have to decide where to place my stop, because if I place a very tight stop, I can be easily thrown out from my position very quickly. If I set the stop loss equal to, I don't know, 10 pips, I could have been thrown out from the position by 1.3246, for example. So to do the calculation, to do the math, I should look for the ATR here. It is equal to 11 pips. 11 pips. So I have to calculate it by 2 and get the value of 22 pips. So 22 pips is the size of my stop. If I enter at 32.56, I have to place my stop at 1.3236. So that is the point for my stop. And you see it works pretty accurately right here. Well, it doesn't mean that this stop is not too tight as well. It is also very tight, but considering that I am working within an area of strong support, I can afford placing tight stops. All I have to do here is to choose right trade locations, good trade locations, to pick a good entries. And now let's watch for continuation of this situation from Canadian dollar, because it's pretty interesting. Later on we have seen the level of rejection. I call it rejection, I call it not support but rejection, but you can call it a support if you like. Price was showing us the rejection. If we ever consider buying on such levels, we also have to decide where to place our stop. For example, if we buy at 1.3307, we go to ATR and get the value of 15. Multiplying it by 2, we get the value of 30 pips. So that is the distance from our entry point to our stop loss. Now let's look how this situation was looking like in real time. If we enter at 1.3307, we have the low of this shakeout equal to 1.3290. So it's around 17 pips. So in this particular case, stop loss is going to be located in quite a secure place. I'm not saying that stop loss or stop placement is the only way to make your trade secure or safe. There is no such word as safe in trading. And remember that it is just one element of decision-making process. I don't want you to think that everything is so easy in trading, because we also have to be aware of trade location, know basic market conditions, know our patterns or our rules for entry, and stop placement is the final element in this decision-making process. While previous example was from 30-minute chart, you can also use stops based on volatility on daily charts. This example shows that if you planned to enter a position on Australian dollar versus American dollar, you could have looked at the ATR and align your stop loss level with this parameter. In this particular case, it is equal to 76 pips, so your stop has to be around 150 pips. And as you see from this example, it allows you to survive false breakout and keep your position. When you set your stop based on volatility, you assume that you are dealing with a random element of the price action. Or at least with a price action that you don't understand. So you set your stop loss beyond possible random deviation, trying to keep your position in the market. The idea is that your setup or your entry point or your trade location may be good and your analysis can be good, but market can retest or revisit your entry point several times, then to initiate a shakeout before going in the direction that you expected. Now let's talk about stop losses based on patterns. It is the most popular way to set a stop loss, and it is the wholly different way of thinking in comparison to stops based on volatility. Everybody is familiar with such patterns as head and shoulders, for example, like triangles, or double bottoms or double tops. On this slide I show you practical application of simple correctional pattern that I was showing you in previous webinars. I remind that the logics beyond the decision-making process for this pattern is that we should have a correctional sequence of at least 3 bars, and then we act when market violates the high of the last correctional bar in this sequence. In this example you see profitable trades and you see losing trades. For example, this trade is a losing trade, and you see that when we enter our position we have to immediately decide when to place our stop. And here we have to place our stop below this pin bar. And once the market violates the low of this pin bar, we get out of this position. And this example shows us that this decision is pretty good. You might ask a question whether this way to place a stop is good or not. Well, in most cases when you enter a trade, market is not going to test the low of the previous bar. But in some cases it is going to go sideways, and if you place a very tight stop, it is not a very good thing to have. Well, I guess that you have to make your own backtests and to see what happens. According to my backtest, it is more reliable to place our stops just below or above correctional sequence in this case. Because also if you have, for example, head and shoulders, which is a very popular pattern used by traders, if you have a breakout of a right shoulder, it is recommended to place your stop above the right shoulder. But in some cases price immediately goes down and you can earn a profit, and you can ask a question: is it reasonable to place such a distant stop? And again, it is a matter of backtest. And I'm saying that there is nothing ideal in the market. You have to choose the way of placing a stop, knowing that it has some disadvantages or drawbacks. Stop based on patterns can be used with any pattern that you trade. For example, in a previous webinar, one of the previous webinars, I was showing you engulfing pattern, and it requires to set a stop loss beyond the pattern. In some cases it may be too distant, and that's why you have to choose patterns that are not too distant, not too elongated, because in this case you expect to have a good profit-loss ratio. And your stop can also be set upon the logics of a certain scenario. The best way to describe it is to remember breakout momentum trades. Once price breaks out from a range or breaks any level, whatever it is, you can have two scenarios in this case. Market can either break out a level or return back to the range. So it either goes or doesn't go in the direction of the break. It doesn't mean that market has to necessarily reverse, but you can generate profit only in case it goes in the direction of the trade. In any other case you are not generating any profit, so you know pretty quickly when to get out of your position. And I would prefer to have a trade with lower frequency of profitable trades, but with smaller stops, knowing faster when to get out, because it is good both psychologically and methodologically. And equity curve of your account may look like this one. So you fix a loss, then you get a profitable trade, then again you are fixing a loss, so you will have very small drawdowns if you know very quickly when to get out of your position. And the latest example of trade with a stop loss based on certain scenario. In this case it is a breakout scenario. It was made yesterday. I am recording this video in December 23rd, and yesterday at December 22nd I have put a momentum trade, the short momentum trade on the British pound, and the level of 1.4866 is a go no go level. So price can either break out this level or return back to the range. In this case I would quickly get out of my position. In this particular case the trade is working for now, so it is still active, it's still in the market, and I'm still in the trade. Here it is breakout momentum trade, and I'm placing a stop using the logics of initiative break, and I can earn a profit only if price almost immediately goes in my direction, or at least it can revisit or retest 1 or 2 times the level before it goes down. Okay, now what is the difference between stops based on scenarios and stop based on structure, which employ areas of support and areas of resistance? I was showing you these logics of decision-making process in previous webinars. Difference is very small, but in case you set a stop based on scenario, you might not have initiative break. You might just go with a breakout. When you expect to have an initiative break, you wait for the bar to close, you build a level, you use this level for stop placement, but in some cases you can just go with a break without expecting to have any initiative break. So you just set a buy stop order, market breaks and goes in your direction, or it just reverses and goes against your trade and you exit the position. So in this case you might not need to wait for the bar to close, but they are pretty similar. Okay, let's once again switch to stops based on structure. I often say that trading within a day or using small time frames, you can pay more attention to levels rather than patterns if you want to capture important information from the price action. The lower time frame you operate on, the more conflicting information you are going to have. Therefore, filtering becomes crucially important while searching for a trade. And remember the webinar Price Action and Chart Trading Part 1, where we were talking about impulse phases, distribution phases, paradigm shift, and other elements of the market structure. For example, here on the dollar versus Japanese yen we had paradigm shift, then the breakout, and market has entered the distribution phase. And as you can remember, the volatility of the distribution phase can significantly overcome the volatility of the paradigm shift. So if we don't have elongation to the upside, if we don't have continuation, we should look at the structure as a weak one. And making our top-down analysis, we can identify that this day was showing decreasing open interest. So for the very next day we can plan a short position. And guess what happens here? I'm switching to 4-hour chart to show you more details. We can establish a short trade. So our stop loss in this case can be set above the high of the structure. And you can expect up to 3-to-1 profit loss ratio in this trade. So this is also the typical example of trade based on the market structure. When you're working with the market structure, you can not only rely on levels located on the top or on the bottom of the trading range, you can also find a level inside of a range to get in a trade and place your stop. I call it rotational center. It is a level that also can serve as support or resistance, but it is located inside of a trading range. And you can identify this level searching for spots with low volatility. This level is often confirmed by the pullback. Volatility in this case is not measured by ATR, it's just sequence of doji bars or doji candlesticks, which shows us that the market is resting at some point at some level. And now you see the trade that is made aligned with the logic of rotational center, which is located at 1.0920 or 19, something like that. And you see that previously, on the previous day, this level was acting as a support, and also this level falls into the center of previous trading range, so it is considered to be a center, really a center. And we can put a short momentum trade in case price violates this level, like it is shown here. It is a real-time short momentum trade. I call it structural based trades and structural based stops. On this slide you see how rotational center can become a support. While it is not located at the top or at the bottom, it is located right in the center. But you have initiative break started from rotational center, then market tests this level, then it tests it once again, and you see how it works. This level acts as a pretty strong support. So placing a stop below this level can be a good decision. It doesn't necessarily mean that you have to wait for your stop to be executed in most cases. In some cases, for example, if you capture a reversal, you have to decide quickly whether to hold this trade or to exit this trade. If you see elongation, if you see sideways action, the odds of establishing a new high are getting greater. So you can just exit your position manually. And another idea. Should we set our stops to break even? It is very popular idea among traders. Setting stop to break even is more psychologically comfortable than statistically proven. In most cases, except maybe rapid culminations, it is better to partially fix your profit. The point is that you have greater probability of success in case you enter your position. Then you don't know really the odds. So placing your stop loss order in a break-even point may be not very good decision, because price can get back to your entry, retest your entry point, then go to the expected direction. So you, in this case, might get rid of the good position. So in most cases I don't place my stop to break-even point. Instead, I prefer to take some profit in the first target and leave the position as it is, waiting for the position to reach the second target. So what about trailing stops? It is just the same. When you decide to hold your position overnight, you automatically accept risks of higher time frames, which make tight trailing stops fragile to shakeouts. I'm not saying that you should not have a trailing stop at all, but making it too tight may be not very good decision. So it has to be located in quite a distance. You should select this number using high time frame. You go to the daily chart, watch for the ATR, or you can also partially fix your profit, like in the previous example. Thank you for watching this video. In the next webinar we will talk about target setting, which is also a very important process. If you have questions or comments to this video, feel free to leave them below, and I will do my best to answer all of your questions. Please be specific to receive a good answer. Good luck, and see you in the next video.